Looking at the results out today, let's just start with your view on AngloGold Ashanti, hearing from Mark Kutafani and also from Stephen Willifser from Metropolitan Asset Management. He would be picking AngloGold Ashanti even over a new gold ETF in terms of potential upside. I know you don't like the gold miners and you're going to reiterate it on this show, aren't you?
Yeah, no, I think, you know, the case holds, and, you know, we see it time and time again that through the cycle, the gold companies, you know, irrespective of whether you're looking at Harmony, Goldfields or AngloGold, you know, probably AngloGold is a little bit better, is that they struggle to generate a return that's in excess of their cost of capital. So for that very reason, we've tended to shy away from them, and the results from AngloGold don't, you know, do anything to deter our opinion.
You must have noticed the gold price up at $1,215 an ounce, and we're back in this positive correlation with the US dollar strength and gold strength coming to the fore as investors run to the purported safe haven status of both those assets. Are you taking any notice of the gold price?
Yeah, you know, obviously we take notice of it, but it is a safe haven asset, and investors will always run for that asset when there is weakness. But you know, I think the fundamental question that I always ask myself is we've seen the greatest financial crisis in 80, 90 years, and we've gone through that already, and that didn't push gold to significantly higher levels. Are we going to see that go to much higher levels now? I don't think so. And the other issue that I have with gold is that there's an opportunity cost of holding it. It's not an asset where you can discount back the cash flows that you're going to accrue from that, because effectively there are no cash flows that flow from it. There is no dividend flow or interest flow.
Looking at Standard Bank, the stock at 106 Rand 94, up I think 1.3%. Good results out from Standard Bank with headline earnings per share up 11%. Impairments halving, which is the important line, isn't it?
It is the important line, and you know, typically when one looks at a bank and you see the credit loss ratio going from 1.8% down to 1%, you know, you would expect to see earnings jump up quite significantly, and I think that's what most analysts were expecting, and expectations for full year earnings were in the region of about 20 to 30%. You know, clearly after these results, they're not going to reach that number, and you know, the major reason for that was the endowment effect, and quite surprisingly was the increase in their operating costs. Their cost to income ratio also increased quite significantly. And I think if you look at the business strategically where they're going, they've stated that you know, their focus is to be in emerging markets. They're investing for that. They're investing in systems, in people, and clearly that's hampered their bottom line growth.
Earlier we caught up with the CEO of Standard Bank, Jack O'Marie, and got his thoughts on the outlook for the South African economy.
It is clear, or becoming clearer, that around the world the recovery seems to be slower and is going to take longer than I think all of us had probably hoped for, you know, 6 months ago. So undoubtedly things are tougher out there, and it's not just in South Africa. Clearly we are affected by what's happening on the African continent as well, and you know, a lot of our African businesses have also been feeling the effects of the, you know, the volatility in markets and so forth. So I think the rest of this year is going to be difficult, and we're probably, you know, looking to next year for, you know, for sustained improvement. I think this is going to be a difficult year for banks.
Of course, you do talk in the commentary about a two-track recovery in the world, of course, the emerging markets versus the developed world, and you're quite strongly placed in those emerging markets. So do you think that you're going to see the fruits of this labour paying off in the shorter term?
We definitely believe that the fruits of the labour will pay off. The million-dollar question is when, and I think, you know, clearly for us, we are still growing and investing. It's not as if we have mature franchises in some of these countries. So therefore, you know, we are in build mode and have been, and that has been fine while the revenue growth has been there. Of course, with revenue growth slowing down, which is essentially what's happened, it has exposed you know, the challenges that we have, and the debate obviously then is, well, how do you embark on short-term cost cutting, or do you keep going? And our view is you keep going. because we think this is a temporary phenomenon.
Standard Bank is everyone's favourite banking stock. I assume it's yours as well.
No, I wouldn't say it's necessarily my favourite. It all depends on the valuation. But I think the most enlightening thing.
Is it among your favourite banking stocks?
There are only 4 to choose from, so they're few and far between. But I think the most enlightening thing about the results when one goes through them is their return on equity, and that at 13.5%, it is very low. Compares favourably to Nedbank, which came in at about 10.5%. But Standard Bank management in their results presentation this morning iterated that for their South African business they expect to earn a return on equity in excess of 20%, and for their African businesses in the high teens. So I think if one averages all those numbers out, you'll probably get to a normalised or sustainable return on equity of 20%, which is significantly higher than where that they're currently operating at. So it leads us to believe that the operating performance of Standard Bank can improve quite considerably, and that the business isn't firing on all cylinders at the moment.
Rank the big 4 in terms of your preference where banking shares are concerned.
Today, if I had to buy, it'd probably be FirstRand, Standard Bank, Nedbank, Absa.
And does that concur with your actual holding at the moment in terms of exposure to the banks?
Yeah, absolutely. That's we've been increasing our exposure to the banks in the weakness now. I think what's happened with the results now is that, as I said earlier on, people were expecting earnings to jump quite significantly in 2010 as the impairment charge dropped quite significantly. We haven't seen that because of the negative endowment effect, amongst others. That came to the fore in the last 2 or 3 weeks, that the results weren't going to meet expectations, and the shares have traded off probably in the order of about 10–15% over the last 2 or 3 weeks. So we think it's a good opportunity for these shares.
Naspers closed 3% lower, and Tencent came out with their quarterly results, disappointing the market, saying that their marketing costs and the World Cup impacted the company's growth. Just to put it into perspective for our viewers, Tencent is owned 30% by Naspers, but it makes up around 80% of Naspers's net asset value.
Yes, I think if one looks at the results in themselves, they were pretty much in line with what everyone was expecting. I think the growth that came out was about 60%, so very high. But I think what probably where investors took fright was just management's comments that the environment. We saw the regulatory issues that were raised a couple of weeks ago, and they just highlighted that growth might not be as high as some investors had expected previously.
Greg Katzenellenbergen yesterday from Sanlam Private Investments said below 300 Rand he would definitely be picking up Naspers. Do you agree with that opinion?
I think I'd wait for it to become oversold on a technical level. I don't think it's quite there yet, but clearly the investment case for Naspers is quite strong. We're in a world which is migrating to digital platforms, to mobile platforms. In China alone, or in China, Tencent has active users of about 600 million users. So clearly that's one of the largest client bases in the world, and if they can monetize that, they're going to accrue significant profits from that.